Ladies and gentlemen, welcome to the midday market madness. Once again, it is very much madness that we're taking a look at here today. Specifically, Meta stock down 3.8%. 3.8% on a $1.5 trillion business. That is scary, ladies and gentlemen. However, essentially, things are not going great for Meta. It looks like it's going to actually be Google that seems to be the beneficiary here, even though they're red as well today, but should not be. New York Times reports that Meta has delayed its new AI model, codenamed Avocado, to at least May after internal test shows that it's still trailing top models from Google, OpenAI, and Anthropic in reasoning, coding, and writing. You can't be bad on all three. I mean, come on now. The report also suggests that Meta has discussed the possibility of licensing Gemini, Google's Gemini, in the meantime. The concerning part here is not that they're not, leading the pack. The concern is that they're spending tens and tens and tens of billions of dollars and then having to potentially go to Google and say, can you guys set this up for me, please? I can't build this myself. That's the really concerning part. Yet Google still down 0.8%. The markets in general not being very strong today. QQQ's down roughly 0.6%, and then the SPY roughly half that. Actually, it's fallen a little further, 0.4 right now. Sodak Zach says, avocado is toast. It might be toast. That's very funny. Yeah. But so Meta absolutely taking a shellacking today, down 3.8%. If you guys still believe that their internal AI tooling is helping them, help with advertisements, potentially the glasses division's going to do well, there still might be some possible upside here. However, it's not great to know that they're hiring the greatest engineers in AI, like history, okay, paying them upwards of like $400 million in terms of signing bonuses and stock-based compensation, all of these different things. And what they're getting out of it is an underperforming new model called Avocado. That is not good to hear. And then in terms of it, it might actually end up being Google that's the largest beneficiary, as well as like Apple, right? Like this could be a massive business for Google. They could come out as being one of the greatest AI winners if names like Meta and Apple and all of these things are not only tapping them for Gemini services, are paying them for it, and probably going to be using their cloud services as well. Then on top of that, with their latest acquisitions of Wiz, that they end up getting their cybersecurity services and the sort of whole enterprise service stack that they were selling to businesses is exactly what they're doing before AI models and tools. Exactly what Google was, the large market share gainer of the internet, might actually be the case here in the AI era as well. It's pretty crazy. Now, regardless of where you pick, it's looking like names like Nvidia are still going to be the large beneficiaries here. There was a little story today that is anti-Nvidia, and I could see them being down on this news. One of their competitors actually ended up signing a massive deal. AWS and Cerebras are partnering to bring fast AI inference to Amazon Bedrock in the coming months. The setup will combine Trainium for prompt processing with Cerebras CS3 for token generation, with BlackRock becoming the first cloud service to offer Cerebras's disaggregated inference systems. So it's not like the only company in this entire space is Nvidia. We'll have to see how that ends up spreading. Obviously, there's been lots of competitors that have sort of come and gone. And in fact, Grok being one of them. Maybe, who knows what comes of this? Maybe Jensen goes, oh, we need to go acqui-hire another business to make sure that they slow down. We won't buy the company, but we'll have some sort of licensing agreement where it's exclusive to only us. Who knows what they'll do? That being said, there was this amazing video that I want to play from ServiceNow CEO Bill McDermott, who talked about on his live stream, on CNBC's live stream, about the future of ServiceNow's business, but also the future of entry-level jobs to begin with. Let's have a listen.
There's a kind of a less extreme version of this, software, enterprise software going to be displaced by AI, which is not that it makes it obsolete,
right,
but that it sort of creates a challenge to the seat-based pricing model and this idea that the customers have felt as if extra services layered on, they're getting aggressive with pricing every year, and maybe it just challenges margins in the forward-going period.
Absolutely heard the same thing, Mike, and it's a fair concern. And here are the facts. On a year-over-year basis, as I stated in my earnings call, our active users are up 25% year-over-year. So people are like, how can that be? Because we're not seeing hiring. In fact, we're worried about hiring and jobs because we're covering so much more territory in the enterprise, an end-to-end platform that goes across the enterprise. So that's one reason. Second issue is, even if seats do go down, we are prepared for that. A large portion of our revenue today comes from hybrid revenue. And let me give you an example. If you think about the economy between now and 2030, there will be about 3 billion agents, digital non-human agents, added to these enterprises. We are the only platform that natively has agents, but also manages the agents of all of the other software companies. So we will have billions of users in the next several years that we could have never gotten from human beings. You charge for that. The other thing is the data in these enterprises is exploding. We have the only workflow data fabric that connects all the data nodes within an enterprise. These are net new revenue streams. And finally, I want to tell you something, Mike. The AI control tower for business reinvention is the big idea. How does a CEO have an agentic layer to have an appless corporation that has complete control of the agents because they are non-human, but they are managing your business processes? So you can't just let OpenClaw into an enterprise or some of these language models without the governance, risk, auditability, and security management that ServiceNow brings to the resilience of a company. We're in businesses now that we weren't in last year. Control tower, non-human identities, security. People say, wow, you went into security. That wasn't a great market reaction in December. Absolutely. But guess what? The world's third largest economy is security, behind only US and China. So the security risk associated with AI is so high right now. We're the only company that on an IT basis and an operating technology basis can manage the whole security posture of a corporation. These are businesses, Mike, I wasn't in a year ago.
You kind of went over being worried about jobs.
Yeah.
How worried?
Well, I think it's very natural to be concerned about jobs. I think young people coming out of university today is like 9% unemployment. I think it could easily go into the mid-30s in the next couple of years.
The mid-30s?
I do, because what's happening now is for the non-differentiating roles, so much of the work is going to be done by agents. So it's going to be challenging for young people to differentiate themselves in the corporate environment. The other thing that's going to be clear, if CEOs follow the ServiceNow platform, what we did is we took out 90% of the use cases that humans used to have to do for customer service. And we're doing this for great companies like Pepsi, Panasonic Aviation, Bell Canada, Nvidia, the greatest company probably in the entire world with our dear Jensen, configuring, pricing, and quoting. All of these non-differentiating technologies are now being done on the platform by agents. So that will definitely put a damper on how many people you need to hire.
I saw you guys talking about the glasses. Yeah, he's partially blind in one of his eyes. His left eye had like severe damage or something. But yeah, he's still the CEO. He's managing ServiceNow. He's an extremely smart executive. So get over the glasses and listen to what the man has to say, because Yeah, he's great. That being said, I think that he's right in terms of the overall chance that high unemployment comes for people coming out of school. I honestly don't even know if I would stay in school right now. Like it's so scary to me, the environment that you're about to go into, especially for professions. Like I was in the financial game. And I just realized, like, obviously there will be financial advisors, but they'll be able to do fewer financial advisors will be able to cater to more customers, and they'll be able to give them more personalized advice. And if that doesn't happen, then there's going to be a competition on pricing. So I was like, man, this is not a great area for me to be in, and I need to do something a little bit more specialized than this. I would say the exact same thing for accountants and lawyers and everything like this. All of those jobs will exist. It's just, I don't know how easy it will be at entry level. How do you stand out? How do you make, how do you separate yourself? No, you should go to school. I've talked to a lot of people who are in school, like even now, they say like 100% of the work that they're doing is just on AI. Like, I'm not even sure people are learning. So yeah, I disagree that people don't want AI to manage their money. Relationships are key. Those relationships are costing you like 2%. You should see the percentage of money going through active management. It decreases like every month, and it's been decreasing for years. People are not dealing with financial advisors. They're dealing with them less and less and less on a constant basis. And passively managed funds, like just putting your money into the SPY or something like this, or if you're paying somebody to put your money into the SPY, passive investing and what Vanguard had essentially created is growing month in and month out. Whereas, actively managed funds and stuff like this are not growing. I was in the industry. Like I never want to be in a place where the total addressable market is shrinking. And that's exactly what was happening. I don't believe in going to school anymore. Just base levels. Work on your creativity, and you'll use AI tools in the future better. Absolutely. Yeah. What happened to Meta? Meta is showing reports that their new models that they're working on are subpar. They're not doing well. And they're spending, in the highest percentiles of overall spend on chips, on headcount, or on talent, like truly the best talent in the world, and it's not leading to anything. Now they're looking to potentially license Google's Gemini. Sad. I'm a lawyer. Generating documents will become quicker, but I can't see robots negotiating with others. Drafting documents is the boring part of the job anyways. Yeah, but I'm not suggesting that your job is going to be taken away. I'm just saying there are a lot of people who, like, there's only so many people to service, and that is being satiated by the amount of lawyers that exist today. So if you can make yourself 95% more efficient, where are you going to find all this new work? And so if you want to take a customer from someone else who is also being handled well, it's like, okay, you have to compete on price. You have to give them more time. You have to offer them a better service. Everyone's going to get more efficient. Lawyers will make less. That's usually what happens. A lot of people compete on price, and there'll be less people needed to do those jobs. Yeah, just so everyone's clear on my stance here, and it doesn't mean that I have the right stance, but this is my stance. Advisors absolutely will exist, but the entry-level ones that are doing, monotonous work, not separating themselves, not offering great advice because they don't know it, Okay. Just putting people into funds, like this stuff won't need to exist. And there will be people that can take on many more customers for the same amount of work, you know. Education will always be very important for society. Yeah. Yeah, it's just I don't know if it necessarily leads to a job like it did before. As Bill just said, you know, he believes that unemployment right now for people coming out of college is already on the rise. Right now, it's like 9%. He believes it's going to go into the 30%. Okay. That being said, on the stocks that we've been covering recently, also, can we try something new? I want to try something new this show. I'm aware that I use filler words. I say, you know, I say like. I say all these things to transition my thoughts into another thought. I hate it. I know it's very hard to listen to. If you guys catch too many you knows, throw it in chat, okay? You guys need to be the spray bottle. I'm the dog here, okay? And I have bad speaking behaviors. If you catch me saying you know, type you know in chat, please. I need to be sprayed. That's the way I'm going to learn. Because half the time, I don't even realize that I'm saying it. I say okay a lot too, okay? Okay, yeah, exactly. So just let me know. And not let me know, okay? I mean, whenever I'm filling words right now. I'm being very cautious in my head not to do that right now. Okay, a new price target has been raised on Nebius. There was once a street high of $211, just got raised up to $291, keeping a buy rating. Could you imagine if they changed that? Hold rating, something like this, implying 170% upside for Nebius stock. No way, I've already said okay. Don't care, bro. I'm trying my best. Nebius is up 5% on this news. Obviously, it's not going to shoot immediately over to this price, but remember, that's a 12-month price target. 12-month price target going from 113 up to 291 is what a REIT research believes this stock is going to get to. Shave the stash, that is anti the markets. You want people's money to go down. If AI replaces jobs, there'll be double tax for AI. Well, I definitely think that should be the case. There should absolutely, I would be perfectly okay with, and I honestly think the big tech companies would be okay with this too, is taxing. Hold on a second, guys. Don't roast me in chat. I got to think. You know, I need thinking time. But the amount of tokens that are actually being used to automate and replace jobs, there should be some level of taxation on that. Or robots that end up, you know, I'm dying here. You know, robots that end up helping people to do manual tasks, sit in factories, replace jobs, they should be paying taxes as well. It's not that the robots should be, but the companies should be. This was a terrible idea. I only need like one or two of you guys to say it in chat. There's like 100 people writing, you know. I'm very aware of it today. Let's go ahead and hear from Rick Santelli about the macro recently. We got PCE, core PCE, GDP numbers, all of these things. Let's have a listen.
And your PCE, durable goods, personal income, and the first revision of fourth quarter GDP. It is all out, and now it is happening. Rick Santelli is the CME in Chicago. He's got the numbers.
Absolutely, and the numbers are populating here. This is our January read on income and spending, and the PCE numbers expecting up 0.5%. Comes in a bit light, up 0.4% on income. Also up 0.4% is spending. We're expecting up 0.3. That's a nice number. If we look at real spending accounting for inflation, it's up 0.1%. And here we get into the inflation metrics. Month over month, headline PCE up 0.3 as expected. Cooler than the rearview mirror, which was up 0.4. That would be the coolest since November of last year. If we take a year-over-year perspective, it comes in at 2.8, 0.1 cooler in both directions, backwards and forwards. 2.8 equals November, October last year, 2.7. Now let's go month over month. Core, maybe more important, especially considering the news of the day and how that news may filter through over the next several months. Up 0.4 as expected on a month over month core PCE. If we look at year over year, comes in at 3.1 as expected. Although this is the only number 0.1 hotter than the rear view mirror, 3.1. Well, that would basically the highest since it was March of 24 to find a higher number. Now let's look at durable goods, shall we? Durable good orders headline expected up 1.1 comes in unchanged. Remember, our last read was minus 1.4, so this is a little bit disappointing. Ex transportation, though, zoom, up 0.4, close to expectations. That follows a 1% increase. It would be the lightest positive number since up 0.2 in October of last year. Now let's look at new orders, non-defense ex hair, proxy for capital spending, a disappointing unchanged. We're expecting up 0.5%. It has been running strong, though, over the last couple of months. It's been up 0.8 and up 0.9 for November. So solid when we look at a multi-month average. Finally, if we switch to shipments, minus 0.1%. That is a bit shocking. We're expecting up 0.4. That'll be the first negative number since August of last year, which equal minus 0.1. Find a smaller number. April of last year, minus 0.2. The GDP, fourth quarter, second time around the block. Our headline number, it gets cut in half. From 1.4 to 0.7. That would be the weakest growth in any quarter since the first quarter of 25. If we look at consumption, 2.0, that's from a 2.4 look on the first look. Second look, 2.0. That would be the lightest since it was only up 0.6 in the first quarter of 25. The price index on GDP, 3.8, 0.2 hotter than both directions, equals the third quarter of 25. To find a smaller number, you're going back to the second quarter of 25. And the last number is core PCE, and that core PCE quarter over quarter is exactly as expected, 2.7. To find a higher number, you're in the third quarter last year at 2.9. Find a smaller number, you're in the second quarter of 25. So these numbers, how do they pan out? Well, you're looking at 4.25 on a 10-year, maybe the best way to assess that. It closed last week at 4.14. We're basically down 11 basis points. 2.56, we're a 2-year close, up 14 basis points on the week. And of course, the 10-year is up 11 basis points on the week. Those numbers, they are big, but they're certainly not huge, especially considering the huge news over the last 3 weeks. Back to you.
Thank you, Rick. Thank you so much. I appreciate that. That being said, there was this interesting report that ended up coming out yesterday from, let me see if I can find it, Ryan Dietrich, that ended up talking about how yesterday, over the last 20 years, is where the market bottoms. On average, markets bottom on March 12th over the past 20 years. That was yesterday. Okay. That can't be true this year because today is down, unless somehow we close out in the green. But we need to do quite the recovery here. S&P down 0.24%. If this can end up recovering, then maybe it can hold true that yesterday was the bottom. But obviously, that's just an average over the past 20 years. It's not the same way every single year. All right. That also brings an average return on the markets of 10.4%. Just to bring this back, as you can see from Ryan here, 10.4% on the average. It's actually very rare that markets actually have a 10.4% or even near 10% year. It's usually much higher or way lower than that, which ends up averaging. But to have an average year is actually quite rare, especially on midterms, which changes this whole thing. If you were to look specifically at midterm years, it's actually more common that it bottoms in Q2 or Q3. But that ends up balancing out. But what do you guys think? Are we near a bottom? Is there going to be any semblance of a trend this time, or are things different because of the war? Because of oil prices? Which is essentially the inverse of everything that's happening right now. If you track WTI, you can kind of follow where the market is on the opposite end. Where is my crude oil thing? Here we go. So if we look at, we'll switch it to a 1 day. If we track this, you'll actually see very similar inverse patterns for the market of where we're trading. When this goes down, S&P goes up. When this goes up, S&P goes down. That's where we're trading right now. So 96.58 a barrel of oil for those just purely listening. But there's also some other things. I saw yesterday. I didn't actually get to watch it, so let's watch this together. But Tom Lee and Kathy Wood, the retail specialists, captured the minds of retail investors, came together yesterday to talk about the markets today. Let's have a look.
Let's welcome in Kathy Wood, CEO and CIO of ARK Invest, and Tom Lee, head of research at Fundstrat, chair of BitMine Immersion Technologies, and a CNBC contributor. Welcome to both of you. Tom, you want to just start with your thoughts on the markets? Why is tech kind of not participating this time? They've been a ballast so far in this sell-off.
Yeah, I mean, I think tech in general has actually held up really well, including software. It makes sense to us because, I'm going to make a counterintuitive statement. Higher oil is relatively good for U.S. equities because, one, the U.S. is a net producer of oil. But as people worry about global growth slowing because of high oil, they want to own growth stocks, which actually makes them want to own the U.S. stock market because it is a growth index, especially the Mag 7 and software. So I actually think that this kind of makes sense. And I've heard the earlier conversation today. I'm also in the camp that I think we're making our bottom this month for the equity markets.
Okay, what about, we got Jefferies down 7%, Deutsche down about that much. A lot of people are trying to look around, poke into where these private credit exposures and stuff might be. What would you say about that narrative right now, Tom?
Well, private credit's been a problem for some time. So I think it has been increasingly revealing, as Jamie Dimon said, more cockroaches. I do think it's probably not as systematic as we might fear. I know people carry the Lehman hammer and think that this is a repeat of the GFC, but again, there's a lot of reasons it's not a systematic one. It's just the size of the market's not nearly as large, but also things that look like credit stress aren't really signaling like they did in 2008. So I think it's hurting financials right now, but I don't think it's a broader problem for the market or the economy.
Kathy, you guys are looking, if I'm not mistaken, to kind of help the public get into more early stage growth companies. And we saw last week, Robinhood did something similar. They're IPOing a venture fund. And this comes against this backdrop where a lot of the kind of growthy companies have ended up in private markets and they don't go public anymore. Then I know the SEC has a big push to try to change that. But one of the problems, as you and others know, is that sometimes they don't perform that well. It's very risky. So could you just comment on the current state of affairs? Like, the private markets have losses. You go in the public markets, people don't want losses, but they want access to growthy companies. Who can they feel confident will help give them the best of the bunch?
Yes, Kelly. Well, it's very interesting to be managing money at this time and to have managed money, very early portfolio manager, early in my years, in the tech and telecom bubble. It's night and day. There was no fear back then. And today there's extreme fear. And there are some reasons, understand that. But I believe, and this is going to fit into what Tom just said, I believe the market, when we look back, maybe at the end of this year, is going to be characterized as climbing a wall of worry. And of course, now with the war, there is another reason. There are another few bricks being put into that wall. This is a really good time to pick up on stocks that might be more volatile. Volatility in our world it does not measure risk as much as it measures uncertainty. And I think the new technology is evolving today, and the way we do, ARC does its research on these technologies to understand how they're going to scale and who's leading the pack. I think we're in a very good position. And the opportunities, this is a technology revolution. And we are not in an AI hype cycle. And we think it has miles to go. And of course, consider the source. It's all we do. But we're beginning to see results, astounding results at companies like Anthropic and OpenAI in terms of their ARRs.
I put in chat, do you guys think that we're nearing an equity market bottom? Please get in your votes. Only about 160 people here so far, yet the majority of you do not think that we're nearing a market bottom this month. If we're getting close, sort of in the short term, maybe 6 months, maybe this year, 31%, 32% of you guys say this. However, another one, no, we're not even close. Currently at 28% of votes. About 60% of you currently believe that there is no market bottom this month. Okay, my arm started to hurt all of a sudden while I was watching that. I'm curious if I'm going to have a heart attack, but luckily you guys can call 911 for me if you see any signs. But boy, oh boy, I'm such a, what do you call it? Hypochondriac. I think that's what it is. Like whenever you're scared of being sick or having any illnesses, whenever my arm just feels like random pain, I'm like, what the heck? Am I dying? All right. Huh? Oh, it happens to me like 3 times a day where I'm like, I think I might be dying. And then I'm like, all right, well, I'm definitely not. Is 911 in Canada? Yes, guys, we have basic facilities. Yes. Okay. Heart attack. Yeah, isn't that how the sign of a male having a heart attack is pain in their arm? It's either it's one of them. Maybe men feel it in their chest, females feel it in their. I know there's something like that. Either way. That being said, regardless of where this bottom is coming in, and please get your votes. I do want to see what the consensus is in chat, which now it's still falling. 39% say no, not this month. Could definitely last much longer. Are you guys willing? Left arm pressure on the chest? Okay, well then we're good. Right arm, I'm just falling apart. That's fine. Old age, whatever. That being said, I was just about to say something. Oh, in terms of how long this is going to last, are you guys going to be able to essentially bear that pain in the short term? Right? Is your portfolio sort of positioned for long-term success? And during these periods of uncertainty, like even these meta reports and everything like this, which honestly could be rumor. We've seen multiples of these rumors, whether it's the AI diffusion rules coming back, Andrew Wang and Mark Zuckerberg breaking up, all of those recently have just been straight up false rumors. This meta story as well could also be, overly negative for no reason. If this ends up happening, can you end up sticking through a portfolio that just takes pain in the short term, but hopefully ends up being worth much, much more in the long term? Yes, but with pain in my eyes, or with tears in my eyes, yes. I get it. What choice do we have? Sell all and hope for better, like a better entry point. I think that's always the, possibility that people run through their head, is saying, okay, well, if I left the market for 2 months and then came back, would I have the same positions that I have today, but at better prices? So yeah. I recently tweeted about it. Having a high conviction portfolio is insanely important. You want to have portfolios that you can sleep well with at night, or at least that's the strategy that I'm going with. One of those names in my portfolio, regardless of my sleep score, is actually BM&R. Low position. You want to make sure that has a low position, or else I'd be freaking out a lot more. But BM&R, although it touched 2276 today, up at 1.10%, has just fallen back down to only up 3%, as Ethereum had, there's no end in sight for Ethereum's volatility, up to 2200, then back down to 2100. I'm in an abusive relationship with my portfolio. Yeah. Hey, Tanner, why is Meta buying Moltbook? What's the bull case on that? Honestly, David, I'm not sure. I'm also pretty sure it's not even a big purchase for them, almost like the Manus acquisition. I'm not going to sweat it too much. I'm buying Meta because they're the cheapest name in the Mag 7 in terms of the multiple that you pay on the company, while growing at 30+%. I believe in the vision of the sort of glasses, long-term strategy. I mean, I'd like to hope that their AI models and everything will be able to do well over time. You'd think with all this high-end headcount and everything that they would have a good strategy, but maybe it's, not panning out that way. But overall, the growth in advertising is a long-term strategy for me. I think advertising is going to be around a long time. I heard a recent thing that they were charging AI models and stuff like this to use WhatsApp as sort of the conversational middleman. There will be tons of new revenue sources for them. So I like Meta here for sure. Tanner, did you add Microsoft to the portfolio? Oh, did you add to your Microsoft position? No, I've added Microsoft to the portfolio. I've not added to the position in a while. I've not added to many positions in a while. I'm light on cash. I'm sometimes scared to write covered calls on some of these positions at this moment because they can be so depressed. Now, Nvidia is really depressed right now, 181. I don't want to write covered calls here, even though it could stay down here for a long time. Maybe that's easy for some people. But with the amount that this company has grown while not moving the stock, essentially it's been extremely resilient. What's better than a company that going down? A company that's at least staying flat. Okay. So it's not like we're falling endlessly like a SoFi or something like this. We've kind of stayed in the same place, but earnings have skyrocketed. And I actually do expect that they will double earnings in Q2 of 2027. Their fiscal year 2027, meaning a quarter from now. Q1, then Q2. If that ends up happening, if they end up guiding for that type of growth, I don't believe that it can stay at this position. Write short-term covered calls, Tanner, do all this stuff, have long-term, or have, far out prices for it, like far out strike prices. I don't want to. I don't want to collect pennies in front of the train right now at these prices, because if something ends up happening, Iran ends up, like the whole war just ends up ending, something ends up just going back to normal, I think Nvidia's price could skyrocket quite quickly. You ended up seeing the price change from 180 up to 195 in a 5-day sort of span. I think that can happen, even more likely to happen now, considering we have less shares outstanding after the new quarter and more growth and higher margins. Yeah, I'm not selling covered calls on SoFi either. Like, I mean, that would just be, SoFi is getting hit doubly right now. So although it's green, it wasn't green this whole time today, still in the $17 ranges. This is more of a time to write, well, I mean, in my opinion, time to write cash secured puts rather than covered calls. But there is reasons to be bearish, right? There's a private market concern that people have, and then there's the chance that we don't get rate cuts nearly as much as even what SoFi guided for in their own guidance. If we don't get those rate cuts, and we only get the 3 from last year, then there's going to be a misalignment from what SoFi was expecting in their guidance and what the market actually delivers, meaning that their earnings are going to be much, much harder for them to beat and raise 3-4 quarters in a row, which is what everyone loves to see from SoFi. The first time that they miss, it's going to be a shock to the stock. You know, we want to see that consistency of beats and raises. So if they want to keep up those beats and raises, maybe the guidance doesn't continue to improve as quickly over the next 4 quarters. So maybe the beats are only by 2% rather than by 10%. Let's see here. You don't talk about hedging, properly hedging nearly enough. Yeah, it's because it's just, you know what? That's something that I need to do better on my own. So I talk about my strengths more. I don't hedge often. You know, I like to do, I'm just not a great hedger because I honestly am a very optimistic person, and that's where my money lies. And I sleep well at night knowing that I'm holding companies that I think are fundamentally strong, and I let the macro do what it does, and I don't benefit from every swing, you know? But what that allows me to do is I take a rashy bunch of crap during these moments in the market, like 2022, for example. I did not perform well in 2022. But then in 23, 24, and 25, I way accelerated, way past what the market was putting up, you know? And so that's maybe what 2026 is. 2026 wants my portfolio to take a deep breath. I will. And I'll be buying at better and better prices in the companies that I think are still accelerating on earnings, and get ready for 27, 28, and 29. Bull markets happen about 7 out of 10 years, and bear markets happen about 3 of every 10 years. I like those odds of me staying bullish. And then you can't also just, swing on those timelines, because the last extreme bull market that we had lasted 12 years. It's the longest bull run that we've had in an extremely long period of time. And all during that, it's not like we didn't have bad news come out. You know, there was bad news constantly. There were people saying that the market was going to sell off way greater than what people thought. And then, technology advancements and American exceptionalism and all of this stuff just continued to push markets higher and higher and higher. And I don't think any of those things have changed. We have an even faster, innovation engine right now. I think we're going to see massive breakthroughs constantly. And I think that that's going to be good for markets. Buy and grab every week while sub 5. Hey, if you like the name, but I think that there's better deals than grab. I mean, grab might be like, I don't think you'll lose money on that. But I think it's not my strategy to be like, oh, this company is so cheap, even though the PE ratio on grab is like, what is it? 62 times PE on grab. And that's at 370. So even at like $5, I remember it being like at a 90 PE or something like this, like really recently, because the margins are extremely low, and financial services could be growing. But if you like the financial services aspect of that business, buy a financial services company. Why even dilute it with a low margin business? Uber's PE ratio is 15. I mean, there you go. It's just not my favorite name in the market. Portfolio update when? I update my portfolio for Future Investing Pro members constantly. But everyone knows my top holdings. Like, You don't need to see what I'm buying every day to know what I'm bullish on. Nvidia, like all the things that I talk about. Nvidia, SoFi, Shopify, Robinhood, Nubank, Google, Amazon, Meta, Nebius, all these names. Did you listen to Rubrik earnings? No, I haven't. I listened a little bit to Adobe's earnings last night, though. All right. Uber, by the way, a ton of new articles are coming out on Uber right now. Doing partnerships with Zoox, with Waymo, with what was the one today? Motional, relaunching robo-taxi rides in Las Vegas using their Hyundai Ioniq 5. Riders requesting Uber X can end up getting fully self-driving vehicles without paying any extra. Hopefully, though, the price actually comes down. That's what's going to make things very competitive for Tesla, right? If I'm paying the same price for Uber X, I'm just getting the privacy, but it should be privacy and price. Okay. BM&R, by the way, we were just talking about BM&R. They just recently saw an additional $62 million purchase, 30,000 ETH. So we'll see if they have more purchases, but they continue to dilute and raise more to get more Ethereum while it's low. Interesting stuff. Someone asked if Perplexity Computer was available for Pro members. They said that they couldn't see it. I don't know. I just read this. This is directly from Perplexity. But Perplexity Computer is now available for all Pro subscribers. It actually doesn't say that. It says for Pro subscribers. My bad. So it's available there. And then on top of that, they even rolled out Computer to mobile users. Look at this. The amount of token usage that's going to happen over the next little bit is going to be insane. And I honestly think that there's going to be some version of Computer across Grok, across, well, that's what, Elon just recently talked about. So they are working on it as well. But Gemini, across ChatGPT, all of these ones. And then it's going to be, the next level of innovation. Who's giving away their tokens at the cheapest prices? Who offers the best services? How do they specialize? And then we see that sort of agentic breakout. QQQ low of days. Uh-oh. Let's go story hunting here. Let's see what we can see. Merchant vessels reported hearing sound of explosions at undetermined distance from the vessel. Oh. Merchant vessels hearing explosions at undetermined distance from the vessel, approximately in UAE's their port or whatever. I'm not going to try to pronounce it. That could also be what this recent candle is that people are selling off on. If that did just happen, if we end up seeing, mines placed in the area and then those are going off, yeah, Trump's going to have a press briefing here in the next little bit, I assume. Crude futures turn positive as Strait of Hormuz remains closed by the war. No update on that. No U.S. Navy bringing them through. Chris Wright just, popped the market for no reason, then disappeared. What's a Perplexity Computer? We've been talking about it the last couple of days, but it was just a little bit of a breakthrough product, almost like OpenClaw, but ran on the cloud. And so it's not ran locally, much easier to access. It's not going to, mess up your files or anything like this. But it can use skills. It can connect to hundreds of different services. Yeah. The only reason why I'm super interested in it is because I believe that it's going to lead to more Nvidia chips being purchased. I think it's the next leg up of like, it's the ChatGPT moment of agents. OpenClaw was, and now Perplexity Computer is bringing a more approachable service rather than just people who are coding and wanting to set up, Mac Studios on top of Mac Studios. And most people just want to go online and tinker. Let's see. SPY in free fall now. Gosh. 0.5% now on the SPY. Okay. Let's see if this recovers quickly. If not, the whole idea of March 12th being the lowest day of the year is looking like it's not going to come true. Looks like we might find deeper reds today. Um, 0.5% in free fall. People are hysterical. Well, I think it's not the 0.5 that people are worried about. Obviously, 0.5 is still a decent sell-off for the markets. Individual names can obviously be down a lot more than that. But in the market, a 2% sell-off in the SPY is a terrible day. Like a terrible, terrible day. 3-4%, we're actually talking about historically some of the worst days in the markets. So even a slight sell-off is bad. But that being said, it's not that this is the bad part. It's that it's on top of all the red that we've been recently seeing. And so we're creating streaks of red. Yeah, it's been brutal the last, couple of weeks. So that's the problem. It's not this day. It's that we've not come up for air in a bit. Okay. SPY is getting to oversold. Oh, what did you guys say in the polls? Let me check the polls. 39% say yes, we're nearing a bottom this month. 37% said no, but we're getting close. And 24% of you said, guys, we're not even close to a bottom. It's going to get way worse than this. You guys are scaring me with those types of comments. Okay. Let's see here. Palantir CEO says AI is evaluating U.S. wartime capabilities. Let's check this out really quickly. This is some additional commentary from Alex Karp. Let's have a quick watch on this. It's only 4 minutes.
Though Palantir is hosting its AIP event today, our Seema Modi is there with Alex Karp. Morning, Seema.
Hi, Carl. That's right. We are joined by co-founder and CEO Alex Karp of Palantir. Alex, thank you for having us here at your Artificial Intelligence Platform conference.
Delighted to be here. Thank you for coming. Normally I would start off by showing off about how wonderful and strong and splendorous we are, but we are in the middle of a war. And one of the reasons I'm very happy we're having in DC is obviously Palantir's core mission, and I would hope the core mission of everybody in corporate America, is to dedicate all of our resources to making sure our soldiers come home healthy and well. And we are very, very focused on that right now.
Of course. What can you tell us about Palantir's role in the Middle East war? How is your technology being used?
Well, well, first of all, again, just to repeat, the most important thing for Americans to understand is our brave men and women are in harm's way. And in my view, and I think in the view of most people in America, and certainly in the world, they're doing really important, noble work. I've read in the papers that we are able to engage and fight in a war in the way we haven't been able to in the past, that we've regained our deterrent capabilities. And partly, obviously, it's the men and women on the front line that deserve most of the credit. But the fact that you can now target more precisely, more accurately, more quickly, and that you, meaning America, can do these things, organize the total power of our fleet and all of our resources, and bring it to bear against adversaries and enemies, has shifted the way in which war is fought. And I have read that Palantir's Project Maven is the core backbone of that. And then I've also read that all the allies, Arab and non-Arab in the Middle East, may or may not be users of our platform as well, and that's expanding rapidly. I think the most important thing, leaving aside the heroism of our troops, which is the most important thing, is our adversaries and enemies are witnessing an ability to fight that they don't have. And they are going to find it very hard to acquire for a couple reasons. We have, for better or worse, as many know, I've been essentially an anti-neocon. I don't really believe in the wars we fought in the past, but because I don't believe in regime change, and that's one of the reasons I'm supportive of this policy that we currently have. But what you want is to have a capacity that no one else can replicate. And America is the center of the AI revolution. The large language models on the battlefield are only useful if powered inside an ontology, and that's our ontology. And yeah, I guess I've read we're at the core of everything, and maybe that's exaggerated, but
Project Maven used to identify Iranian targets, including the Supreme Leader.
Well, I can't obviously go into specifics, but there are two things that are very important about this in general. One, you have to take infrastructure, both commercial and in government, that was built for an industrial age, and you have to transform that into infrastructure that takes advantage of the industrial capacities and then puts them in a position where they can use post-industrial technologies, AI. What Palantir's products do in commercial and in government is take latent infrastructure, hospitals, planes, engines, missiles, and allows you to coordinate in a way as if it was built for today, very, very rapidly. And then we layer things on top of it that did not even exist a year ago, like being able to do 1,000 munitions that would have taken 2 years, 5 years ago, being able to understand what hit, how it hit, under what conditions, what's actually also coordinating between allies. Like if you, as a matter of theory, you're coordinating between allies that do not have full access to our data. And how do you do that? Well, that's a software Palantir uniquely driven problem that currently only we can do.
So Palantir. We're now joined by World.
I see a lot of comments regarding the school bombing or whatever. It actually, like, the school thing makes me so confused. I don't know if anyone has taken responsibility. Last time I heard, Trump was saying that, he could believe it might have been self-inflicted or something like this. There's questions regarding if Iran could even get their hands on a Tomahawk missile. I don't even know. I don't have much to comment on that. It's sad, but like, what would even be the proposed target? There's some I see people talking about like bombing those inflatable tanks and everything like that. Well, I mean, clearly the target was a supposed tank. Maybe they got that wrong, but like, did they confuse? Like, I don't know. I'm skirting on a tightrope here, but it makes me question, like, what was the intelligence that even led to a potential girls' school being the target? If that was even the United States at all. An empty warehouse next to it? Oh. Okay. That being said, this is something that happened recently with Trump, which seems interesting. Jake Paul, in the midst of everything, interviewed the president. This just came out about an hour ago. And yeah, supposedly they talked about immigration, the Iran war, everything like this. I don't know if there's any good clips, and I don't have timestamps. But yeah, Very, very interesting. By the way, he's not an interviewer from my understanding. That's more of his brother's thing, the Logan Paul. Okay. Turkey will not be dragged into the Iran war, but is prepared against all threats. Okay, let's check out the markets right now. Meta is down 4.2%. Absolute bloodbath today. Tesla at one point was green, now down 0.5%. Apple down 1.7%. Nvidia down 1.5%. Amazon down 1.3%. Microsoft down 1.3%, under $400 a share. And Google also just broke below $300 a share, down 1%. Google below 300 or bouncing on that, $300 line. Pretty crazy. Tanner, why has SoFi been dropping for weeks? There is a private market concern. Names like Blue Owl and BlackRock and all of these names are having some pretty big cracks in the system right now. People are worried that they're going to even see a return. Some redemptions are being blocked. Obviously, SoFi has had some problems with recent securitizations as well, triggering losses and stuff like this. So, there's just concerns that maybe larger losses might be seen, but this is why it's important that they've continuously highlighted that they're going towards more fee-based revenue. Okay. Nubank also, what a freaking red candle this is. This company is now under $14 per share. Obviously, great concerns about LATAM right now, and names like Mercado Libre and Nubank, honestly, have put up some of the best quarters that I've seen from businesses over the years that I've covered them. And yet these stocks are at some of the cheapest prices that we've been able to follow them at. Mercado Libre, even at a larger sell-off than Nubank, but Nubank has just delivered amazing numbers and not being seen in its stock price. It was an old IRGC site which was converted to a girls' school. I see. Is that confirmed, or is that confirmed? Or is that your suspicion? Because you said that Palantir didn't have the latest maps, but I know for a fact, well, at least I'm pretty sure Palantir has not fessed up, or anyone has fessed up to this actual bombing. So okay. Better Homes down 8.5%. Is anyone in this name? I know Eric Jackson said a little while ago this was like a 300x or something like this for him. Or sorry, that's what he had called for in the future. Stock has run up and then come back down since October, back down to roughly $30 per share. Is anyone in this name? Aitco down 8% after having a good day yesterday. Adobe down 5% on CEO transitions from yesterday's call after 18 years in the business that, he's transitioning away. Chime down 4.4%. Nasty candles here. Oh my gosh. Down 4.4%. It's crazy that even silver's down $73 an ounce. Gold, at least the ETF rate here, 463. I think that's 1/10, something like that. I forget how they break it out, but 463 on the Spider Gold ETF. Thoughts on Robinhood's February results? So, yeah, I mean, they were okay. Nothing too crazy. We ended up seeing net deposits go up, and that's the most important part, in my opinion. So if you end up taking a look at Robinhood's results here, they ended up adding on 140,000 new customers this month. Total platform assets went down, but not as a result of people taking away their money. Excuse me. We ended up having net deposits of $5.6 billion, right? 21% growth, which is great. But obviously, people's performance in the business is like in equities and in crypto and stuff like this has been falling. Cash sweep also not as bad as what was displayed. They end up in February 2026, we moved over $6 billion of cash sweep balances to free credit balances. And then equity notional volume, it's important to look. So 14% month over month, but on a daily average, because it's very important, February is much different than most months, that was only down 11% month over month. Is it good? No, but obviously the markets were not strong in February. Option contracts down 10% month over month, but actually 5% month over month on daily volumes. Crypto was actually up 21% month over month on daily volume, and the margin book slightly came down. Even though markets did not perform, people had reduced their risk. We'll see what ends up happening in March. Well, actually, we won't see March until next quarter results because they share their monthly metrics. So yeah. Well, actually, that's not true. They show off color now, right? So we'll see like a decent amount of March. Not all of it. William in chat saying, what's up with the massive BM&R move this morning? William, how you doing, brother? When am I getting that underwear, by the way? I thought you were going to make me a pair of underwear. Unless I have your name tag wrong. I'm pretty sure he said he wanted to make a pair of underwear that you could slide an ice pack into to protect your boys in the sauna. Females, you're all good. You don't need this stuff. It's for guys. It's for weirdos like me. I might even be the only customer. I don't know. That being said, that being said, BM&R just went up purely on what do you call it? Ethereum pricing. Patented, yeah. Bro, what? I don't know if this is TMI, but saunas kill sperm levels. Not good. I have the prototype for you. I'll legit send you a pair. William, am I blinking, bro? Like, message me. I, for real, will be your first customer. The big winner today is Nebius. Dude, they had such an insane upgrade. Like, think about the upgrade that they just had today. One of the biggest bulls of the company at a $211 price target, which is $100 higher from here. Ended up saying, you know what? 211, we're not bullish enough. We ended up changing the price target to 291 12 months from now. Okay. Okay, so we talked about Robinhood. We covered BM&R. U.S. Senate passes landmark housing bill with CBDCs, central bank digital currencies, ban until 2030. Pretty freaking exciting. I know a lot of people had big concerns, especially with crypto, that the United States was going to have CBDCs, but it was a bipartisan pass. All right. TikTok parent ByteDance secures high-end Nvidia chips and is using a cloud provider to end up getting a hold of Blackwell chips. Nvidia claims that everything's still, like, it's fine. It's built in Malaysia. We're allowed to do this. 36,000 B200 chips in Malaysia is what they're getting access to. And then you see ByteDance come out and they're like, we're making our own chips. We don't even need Nvidia. And then they do stuff like this. Nvidia selling all across the world. Gotta love it. I recently started investing as a student. I made the mistake having BM&R at top and a 35% of my portfolio. Now just holding it, learned my lesson. I mean, yeah, that's a lot of risk. Things can go wrong, right? In companies, especially speculative ones. I do think that it will come back. I think that Ethereum's price will come back, but It doesn't have to. There's no like underlying business that's taking customer revenue or something like this. You have to be very careful. But hey, if you just recently started investing as a student, you probably didn't burn all that much money. You'll make that money back. Okay. Nvidia is the first cloud provider to bring up an Nvidia Vera Rubin NVL72 system for validation. Where did you see this? Is this out now? Up to $10 million plus rewards for information on IRGC key leaders. Wow, the United States just put this up. If you know information, call the United States. That's crazy. They're like, we have bombs and they're looking to be dropped. That is wild. Okay. I love that Microsoft news. Doesn't it have to be correct information? Yeah, I assume so. I'm not telling you guys to call. I'm just saying, you know, they mean business. Don't prank call the number. I'm just letting you know the updates as I see them. Wild day for Meta here. Down 4% is so big on a $1.5 trillion business. Can you talk about Meta? So honestly, I'd have to say go back and I've probably talked about Meta maybe 4 or 5 times this time. I'm not changing my position. I do like Meta. I believe in their advertising business. But yeah, it's not a good day for them. WTI's at 99. Uh-oh. Uh-oh. That is not good. Let's see it pass 100 again here. 98.92. 99.10. Oh gosh. Remember, the market is essentially treating this as like an inverse indicator. As this climbs, the market will go down. Let's see where you guys think. Where do we top out at for oil prices? What was what was like the local top recently? 116. Okay, so let's do a poll in chat really quickly. I want to see some consensus here. We have some amazing oil investors. Prices at what will oil price cap out at? Let's put it at 116. Already hit. We'll say 120. Or no, that's too close. We'll say 140, 180, 200. What do you guys think about that? 170? Pick the closest one that you can get your that you can pick. If you don't think it'll surpass the latest high, pick the first one. 130 to 150. 149.76. I mean, bro, you've got the crystal ball. You said, I know where it's going. No, I'm not talking about an all-time high. I'm talking about a local high. I'm just saying a local high. What it hit, this week. I know 200 is not the likely thing. I'm just seeing if we have some panickers in chat. Isn't it a good thing that oil is so expensive now, so we can accumulate more shares of our favorite companies? I think, if you have cash, that could be great. I'm all done purchasing. I'm ready to go higher now. So I think it depends on what your position is. If you're sitting here in cash, you're a buyer. You're looking for things to go lower. If you're saying 110 or whatever, just pick the 116, because literally last week we ended up touching 116 here. So that's what you're believing. If you think we've already hit the top, hit the first one. Okay. While that's happening, consumer staples will lose pricing as energy costs rise from the Strait of Hormuz blockage right now. While this is happening, let's listen to this. Nothing erodes faster than high gas prices. Ooh. Okay, let's have a listen. If it hits 100, I'll pause the thing and let you guys know.
Right now, we want to bring in our panel to talk a little more about this. Former Trump Treasury official Joe Livornia and former Biden Treasury official Kitty Richards. Joe, what do you think happened here? Because I know your take on all of this was that the government, the economy was in pretty good shape before everything happened in the Middle East, but these numbers suggest a little differently.
We kind of came right back, Becky, to where we were in the beginning of the quarter when the outlook was that things would be soft because of the shutdown. It would weigh on income. And as Steve related, you're going to get that payback in the first quarter of 26. So the economy, I think, still fundamentally is pretty healthy. The tax incentives on the building, especially the structures, 100% expensing, and then, of course, the no tax on tips and overtime is going to lead to huge refunds. The biggest issue, though, as you know, is what's happening in commodity markets and energy, because it takes what I believe is a very fundamentally solid economy, one that is going to accelerate, is now cast doubt on it, as you can see in markets, which are worried about the extent and duration of this energy move, because there's nothing that will take liquidity away from households faster than higher gas and oil prices.
Kitty, what do you think? I mean, obviously, the events that are happening on the ground right now are complicating any sort of clear vision on what we might be seeing in the economy. But these numbers do come as a surprise. What are you betting at this point, just in terms of where we stand?
I think these new GDP numbers are surprising. They were much lower than expectations, but they are also consistent with what we've been seeing in the job market. So last month's job market report from BLS showed that we actually lost 92,000 jobs across the economy in February. They also revised down December jobs, and so it was negative. So I'm wondering if we're actually seeing some of those labor market indicators and GDP come into line. That does paint a softer picture. And of course, we're seeing inflation remaining elevated. And the fact that core PCE is still quite elevated, moving into a period where this, chaos in the Middle East, the war that Trump has embarked on, has caused gas prices to go up dramatically in the last week. Those will continue to rise. Oil is trading around $100 a barrel. When you add that on top of persistently high non-energy inflation, we could really start to see inflation tick up.
Hey, Kitty, two things. One is I love the book that's right behind your head. So I wanted to say I appreciate that. I caught that. I don't know if others caught that. I won't say more. Just on the left side of there.
1929.
No, it says too big to fail.
Oh, okay.
And then Joe, it's nice to see you. My question, which relates to where I think Kitty was going with this, is what is the chance, and I know the administration's been pretty persistent with the idea that, you know, if things can get resolved, all of a sudden the price of oil is going to go.
By the way, she didn't seem to realize that at all. Her like face faded away. She was like, I don't even know what book you're talking about. Bro wrote it. All right, let's go back.
Down again. But what is the chance it remains elevated for some period of time, even after fighting ends, if you believe that that is even possible?
Well, the thing is, Andrew, you know, you get these big oil spikes. They tend to go up very steep. The slope on the line is high. It's sharp. It's almost a right angle. And generally, when the situation is resolved, prices come down. So whenever this crisis ends, and hopefully sooner than later, I do expect prices to go down. The problem is the length and depth with which these prices rise. In 22, we had a lot of stimulus. The economy was overheating. We had very strong job growth, 300,000. Now the job market, I would argue, is going to turn up because it will follow the CapEx trend and the pro-growth tax policy. But with this energy move, that kind of throws a wrinkle in things. It seems to be the markets are still betting on a relatively short conflict. That certainly will help. But again, the longer we keep these prices higher, inflation will go up. That will collapse real income, hurt spending, and lead to a stalling out in growth.
One thing to bear in mind.
Oh, go ahead, Kitty.
One thing to bear in mind about the job market is what we've seen over the past year is that a large share of job growth has been in the healthcare sector. And last year's budget bill, which cut taxes for the wealthy very steeply, but also cut Medicaid and failed to extend really important subsidies for Affordable Care Act coverage, has led to millions of Americans losing their health insurance. That is going to, and also they're facing rising costs for healthcare if they were able to keep their insurance. And that is going to have real impacts on the healthcare sector, on jobs, as well as on Americans' pocketbooks. And I think you're seeing some of those pressures also feed through to that disappointing consumer expenditure that we're seeing. Consumers are really strapped. They're seeing prices rise for utilities. They're seeing prices rise for gasoline. They're seeing prices rise for food, and premiums for healthcare going up by hundreds of dollars a month in many cases. And that's really putting a squeeze on their ability to spend. And consumer expenditures are the driver of GDP growth in this country. And so I'm not as sanguine about what's going to happen in the labor market or with GDP over the coming year.
Hey, Joe, do you worry about that? And I guess if you would put yourself in the Federal Reserve's position, do you worry more about the potential for a softening economy, a softening jobs market, or do you worry more about what these higher oil prices mean for inflation?
Well, on the labor markets, the real wages under the first 11 months, 12 months of President Trump's term have been very positive and very strong. Blue-collar workers have seen huge wage gains. The problem, of course, is now where we are with the situation in the Middle East. So to me, as I said earlier, the economy is fundamentally healthy. But this oil move is a concern. And I do believe, as I've said many times, the Fed should be cutting interest rates to help the cyclical parts of the economy to grow, because the Trump tax plan is disinflationary because it increases the supply side of the economy. However, if you're the Fed, having gotten burned very badly with transitory in 22, 23, they're going to sit and wait, as Rick said earlier, and you see it in the markets, we're pricing out Fed easing. So it does cause a risk, because when in doubt, the Fed's going to sit back and is going to wait. They don't want inflation expectations to become unmoored. And because of that, nothing is going to happen. The yield curve is bare flattening. That's not going to be good for interest-sensitive activity, which is why what happens overseas needs to be resolved as soon as possible.
Really quick, while that was playing, I just saw this is happening in Lebanon, I think. Yes. Happening in Lebanon, Israeli Air Force ended up dropping leaflets. Look at this. How crazy. This reminds me of like some Hunger Games stuff. dropping leaflets saying that, citizens must take to the streets to help take out Hezbollah, the, forces that are helping Iran. That is wild. That is next level war propaganda right there. I'm not even saying propaganda in terms of it being the wrong or right strategy. I'm just saying, like, wow, that is pretty crazy. Ladies and gentlemen, that is the end of the stream. Okay. What are leaflets? Pamphlets. Brochure. That's the end of the stream. Really do appreciate it, guys. Thought I had a little fun tweet today. I know people make fun of me for showing off my sleeve scores, but come on now. Come on. Okay? And who doesn't want to see that face? Look, this is what the markets are doing to you guys. You guys are freaking out, flipping desks, staring at the ceilings, freaking out at night. I'm sleeping well, all cozied up in my bed, knowing that 50% of my portfolio is in Nvidia, and I've got Shopify and SoFi, and I'm just conked out. Get your sleep. It's healthy for you, helps you make better decisions, reduces all-cause mortality. Okay? Build your portfolio for the long term. I love you guys. Thank you all so much for being here. Really do appreciate it. But until next time, bye for now.